So on January 8th, 2026, the stock market did something, well, kind of weird. It sent two completely opposite signals at the exact same time, and it created this huge puzzle for investors. You had one part of the market soaring to new heights, while the other part just stumbled. It was a day that perfectly captured how confused the market is right now. Okay, let's dive in and see if you can solve this thing. Look, we're not going to make you wait till the end for the answer. Here's the conclusion, right up front. The market is in a major transition period. What does that mean? It means we're shifting away from the environment that basically defined all of 2025. The one totally dominated by big tech. And we're moving into something new, something different, and frankly, something a lot more complex. And this slide right here, this is the puzzle in a nutshell. On the one hand, you've got the Dow Jones, which is packed with all those old school industrial type companies hitting a brand new all-time high. But on the other hand, the tech-heavy Nasdaq is selling off. So you have this incredible strength and this noticeable weakness all happening in a single day. It's wild. So yeah, this brings us to the big question for today's explainer. Why? Why is the stock market sending two completely opposite signals at the same time? How can one part be celebrating a new peak while the other is clearly taking a step back? What powerful forces are pulling everything in such different directions? That's exactly what we're about to figure out. To get to the bottom of this, we're going to investigate three key drivers that are flowing just beneath the surface. These three things really explain this great divergence. All right, here's our roadmap. First up, the classic tug-of-war between a really strong economy and the Federal Reserve. Second, we're going to follow the money in what people are calling the Great Rotation. And third, we'll unpack the new political wildcards that are shaking up some very specific sectors of the market. Okay, let's tackle our first driver, this battle between the economy and the Fed. Right now, we're in a very strange good news is bad news environment. It's a weird spot where any sign of economic strength is actually seen as a negative. Why? Because it might stop the Federal Reserve from delivering the interest rate cuts that investors are really banking on. And make no mistake, the economic news has been surprisingly strong. I mean, just look at this. Labor productivity just grew at a stunning 4.9% annualized rate. That's the fastest we've seen in years. This points to an economy that's absolutely roaring, which makes it very difficult for the Fed to turn around and say, yep, time to cut interest rates. But now what's really fascinating is the other side of this coin. Despite all that strong data, you have a Federal Reserve Governor, Stephen Miran, publicly calling for 1.5% worth of rate cuts. This creates this massive conflict, right? The data says hold, but a key Fed official says cut. And it just leaves investors totally stuck in the middle, trying to figure out which signal actually matters more. All this tension brings us to our second driver, a massive reshuffling of money in the market. So with all this confusion, where is the money actually going? Well, you can see it right here. The money is flowing out of technology, the sector that totally dominated 2025, and it's rotating into what are called cyclical sectors. Think energy, consumer goods, and defense. Now, cyclicals is just a fancy way of saying they're parts of the economy that do well when the overall economy is strong. This basically confirms that investors are betting on Main Street over Silicon Valley, at least for now. And that brings us to our third driver, the political wild card. The new Trump administration is sending out a whole flurry of policy signals that are directly impacting specific sectors. For example, a proposed 50% increase in defense spending, that's lifting defense stocks. Talk of managing Venezuelan oil reserves, that's boosting energy companies. Each of these headlines is creating very targeted winners and losers, which just adds more fuel to this market divergence. Okay, so we've broken down the forces causing this split market, but let's get to the so what. What does all this actually mean for your investment strategy? It means a classic, almost old-fashioned investment strategy is staging a major comeback, the 60-40 portfolio. For over a decade, this strategy was basically declared dead. Why? Because with interest rates near zero, that 40 in your portfolio, the bonds, paid you almost nothing. They were just dead weight. But now, that has completely changed. So why is this strategy being reborn? It's really for two simple reasons. First, on the bond side, with the 10-year Treasury bond yielding a solid 4.185%, that 40 part of the portfolio is finally providing some real meaningful income. And second, on the stock side, after that massive tech rally in 2025, a lot of stocks are just looking really expensive, pushing investors to look for the relative safety and balance that bonds now offer. But listen, this market transition is far from over. In fact, things could get even wilder in just the next 24 hours. Let's take a quick look at what's right around the corner. The rest of this week is absolutely pivotal. Tomorrow morning, we get the monthly U.S. jobs report, which is going to directly impact what the Fed does next. Then, tomorrow afternoon, the Supreme Court is set to rule on the legality of the Trump-era tariffs, a decision that has huge implications for global trade and inflation. The stakes are incredibly high. So as we head into these major events, here are some key warning signals to keep an eye on. Watch the VIX. That's the market's fear index. If it spikes above 20, that's a red flag. Also watch the 10-year Treasury yield. If it starts climbing past 4.5%, that's a sign risk is rising fast. Think of these as the tripwires that could signal this transition is about to get a whole lot more turbulent. So all of this brings us to our final and really the most important question. The market is clearly shifting gears. It's moving away from the easy money, tech-driven trends of last year, and it's embracing a new, more balanced, and, far more uncertain environment. So the one question you should be asking yourself is this: have you adapted? Is your portfolio ready for this new era?